Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week, we're delving into UBS Asset Management's Red Thread publication. The Red Thread, formerly Panorama, is released biannually, and its recent renaming perhaps speaks to its editorial approach, that is, to tackle topics from many different angles to help readers find a common thread and, ultimately, make sense of important trends that can help them to better navigate the often complex maze of investing. The red thread we're pulling at in this edition is the Disruption edition, and in particular, we're focusing on the Filling the Void chapter about the history and the future of lending disruption. Here to discuss the history and the rise of private lending, and to consider what might be next, we have an excellent panel for you. John Popp is Global Head of UBS Credit Investments Group. Joe Sciortino is Head of Investments for the Americas for Hedge Fund Solutions at UBS Asset Management, and Rodrigo Trelles of UBS O'Connor. Let's start with John Popp from UBS Credit Investments Group. John started the business as an independent shop back in the 90s. John Popp, a warm welcome to the show. And, well, let's go back to the 1990s and talk a bit about the foundations that were laid around that time in the private credit space. Talk to me, John, about how that set the stage for some of what we see today.
You know, it reminds me of seeing a panel a few years ago at the Milken conference, and it was on private debt. It seemed that year that almost every panel was on private debt, but one of the new entrants in the market, headed by somebody who'd been around for a while, got up and said, let me talk about the original private debt. It's broadly syndicated loan market. And I kind of rolled my eyes because I thought, well, that's a little rich to be up on this panel. But in a way, he was right, because to the question that you just asked, loans were always a private market. And when I started my career in investment banking back in the 80s, when a buyout came along, there was Manny Hanny, there was Chase, there was Chemical, there was Nations Bank, there was First Chicago, there was Continental Illinois. You could just keep going down the list. And then the banks did the bank loan, and the high yield market provided the bond component of a capital structure. And as we moved into the 90s, in the Clinton administration, Glass-Steagall was struck down, and that really triggered a pretty aggressive wave of consolidation in the banking industry. And what we saw was really where if Bank A owned X million and Bank B owned X million, they didn't want to own 2X, they wanted to own X. So you began to see the development of an institutional market for the loan asset class. And the early participants there were referred to as the primary funds. Now just somebody might refer to it as a loan mutual fund. And loan structures changed a little bit, where banks would continue to underwrite and buy the revolving credit facility on a pro rata basis with what was referred to as an amortizing term loan A. And for the institutions that didn't want to get paid back right away, honestly, there were these alphabet tranches that had a kind of a bullet maturity and higher spread, but you were part of the same credit. And I think the real pivot came with the development of the collateralized loan obligation market. And I did my first CLO in 1995. At the time, I was at a French bank with some other colleagues from my investment banking past. And what was appealing to the bank about that was it would allow them to move hold positions into a more efficient place, getting them into the CLOs. The CLO market itself took off. We continued to see consolidation in the banking industry and the continued institutionalization of the loan asset class. And as with many developments in any of these markets, when you have massive volatility or dislocation, things shift. And I think the big shift in terms of at least the talk about private debt and what it's become came in the wake of the financial crisis. And the first place I think private debt really started to get used as a term. And again, the reason I started off with that little anecdote about the fellow referring to the original private debt is, even today, whether it's broadly syndicated or in a, something that referred to more as private debt, they're all private. None of this stuff is publicly registered. I think the big distinction is who are the parties involved and how is the negotiation taking place. And really, to me, when people refer to private debt, they're talking about direct lending, where there's more of a bilateral relationship between a borrower and a provider of capital that's disintermediated the bank. So in the wake of the GFC, the banks cut back on lending initially really to small and medium enterprise type businesses. And you started to see firms develop that were targeting that sort of orphaned community of financial need. I would say kind of the mid-2010s, one of the phenomena that occurred was the pivot by the private equity community to develop their own internal capital markets capabilities. And what we began to see was that the PE shops themselves would start arranging their financing facilities. So we would get a call directly from XYZ buyout firm on paper that we historically would have gotten a call about from a bank. And from the perspective of the buyout firm, they could do things on a more bespoke basis. They could do things more quietly. And to some degree, I think they considered it as maybe de-risking, but certainly also cutting out the fee component, which is where the banks, I think, have gotten increasingly focused on how do we address what's going on in this market? How do we continue to be relevant if capital from a regulatory perspective is becoming more costly?
Let me ask you about the regulatory environment, John. Give me a sense of how regulation shapes the space, how regulatory appetites, regulatory frameworks are shifting, and what that means as we look at the continuing rise of private credit going forwards.
Well, I think that if you go back into the early 90s, banks accounted for 70-ish% of the ownership of the leveraged finance market, and that's down to probably 5%. I think it's not so much that the ownership shift, I think was accepted because they could continue to do the underwriting and make their fees. But, all along the way here, it's just become more punitive to hold assets on the balance sheet. So the capital charges attendant with that. And I am not the right person to talk to about the specifics there. But thematically, I don't see that changing. And interestingly, the banks are eager to lend against private debt assets. So many of the funds that are raised out there will have credit facilities to allow leveraging. So I put my dollar into a private debt fund, and the fund itself will then go out and borrow from a bank to enhance the return profile there. But that's because of the subordination to the bank on those loans, they carry less punitive risk weightings. So it is kind of ironic, but while they don't necessarily want to own the loans directly, if they're happy to lend against a pool of them as long as they're not in that first loss position. So all the fund investors are in the first loss position. So maybe they'll lend comfortably 30 cents on the dollar and be able to account for that in a way that's favorable so that the return on that loan is superior to actually owning that loan outright because of the capital charges that would be associated with the risk as viewed by the regulators.
Well, on that point, what's interesting is that there do seem to be, not just from the research, but talk to lots of observers in the space, and they say, look, there are lots of factors that point to private debt market potentially growing or swelling at, even at a faster pace as we look forward. And they mention other things. Your colleagues talked a little bit about the SVB collapse, the sort of run on the banks, the regional banking crisis, certainly stateside, which spread a little bit to other markets too. Do you think there are lots of pointers that this is a market that is going to continue to grow as we look forward?
I think it will continue to grow. And again, I think you're going to see continued growth in sort of this whole collective of corporate credit related products. So, the CLO market, the broadly syndicated market, and the private debt market. But again, on the private debt, I think it's really about direct lending, because private debt would also encompass venture debt, infrastructure debt, real estate debt. When you see that big headline number like of $1.7 trillion, only about a third of that is what would be referred to as, in the direct lending context in terms of the money raised. So, I think it's really just private markets generally, and any asset class that kind of is out there, if there's something that can be done privately, seems to be having more incremental appeal, up to the point where I think this has driven a reasonable amount of growth in the credit space. Is institutions, I think, have historically felt more comfortable with illiquidity. Individuals less so. And some of the big raises that have been done in retail, have tried to thread that needle. It's how do I provide somebody, quote, private markets opportunity, and then also be able to deliver liquidity for them. And I think that's a struggle. And I think some of the funds that are out there that are trying to do that are really looking to what would be referred to as the public markets to provide those portfolios with a liquidity option to meet, whether it's on an interval basis or, whatever the basis is where investors can get their cash out. So I think the real direct lending that is looking to provide the incremental return and the low volatility, I think you really have to be able to embrace and be comfortable with a longer illiquidity profile.
John Popp, thanks very much for being with us. Well, next let's hear from Rodrigo Trelles, co-head of O'Connor Capital Solutions. Rodrigo's managing director, running one of the private credit strategies. Rodrigo, welcome to the show. Look, some fascinating background there from John. Can you give us your sense of the development of private credit and indeed of those key moments, some of which John's mentioned, that have shaped both its growth thus far and its ongoing potential?
From my point of view, private credit had two key inflection points. One was with the global financial crisis and the other one with COVID. Private credit includes much more than direct lending. People, generally speaking, associate private credit with upper middle market direct lending. The reality is that, yes, that is the vast majority of the market, but private credit includes much more than that. So the reality is that the growth of private credit has come hand in hand with the growth of private equity. And as I said, the first stage of that was in the global financial crisis, after the regulators took the approach of tighten the framework, the regulation for the banks to lend. And that's when the asset managers started to fundraise to provide lending capacity to the private equity industry, if you will. That is a process that really started to kick off after, I would say, 2010. There were great opportunities, those are great vintages. And then something similar happened with COVID. Managers raised more funds, and now you see some asset managers competing with the leveraged finance market. So the checks have grown in size quite a lot. In 2023, in particular, there was a lot of competition between some asset managers and banks in terms of who was going to provide that financing for the M&A activity that the private equity firms were executing. So it's a very interesting time in the market right now. And that's the genesis of it. It started with regulation after the global financial crisis. And then the borrowers appreciated the flexibility and conviction with which private credit managers move in the market.
Well, also with us is Joe Sciortino, who runs the credit side of the multi-manager business in Hedge Fund Solutions. Joe, what's your view?
I think, the rise of private credit is really just a shifting of debt that used to be done and held by banks and now is held by private capital. There's really no change in the actual market. It's just more who's holding that debt and how it's originated. And, it's all related. So everything that's going on in the broadly syndicated market and the high yield market is all related to the private credit market. And I think that's what people don't really understand is how these different dynamics affect each other, whether or not the CLO arbitrage, what that means for the upper middle market for direct lending. And I think that's where we come in and we can really evaluate different strategies based on what's going on in regulation, in supply, in demand, and really in the quality of paper. So.
Yeah, that's super interesting. And just tell me where we're at, because Rodrigo set the scene a little for us in terms of looking back to 2008 and how that changed. Well, I guess some underlying trends that were already there in terms of the availability of lending to small to sort of SMEs and the shift away from that. I guess the crisis accelerated that. Where would you both say we are now, a decade and a half or so later in that process?
I think it's actually gotten even harder for lower middle market companies and assets to find lending. And the issues with Silicon Valley Bank and the increased scrutiny on regional banks has only accelerated that. So I think it's a great opportunity for private lenders in that segment in the market, and not just on the corporate side, but also in the specialty finance and asset-backed side. There's a lot of opportunities where regional banks were very active and now have pulled back.
Yeah, and Rodrigo, let me bounce back to you. There's all sorts of interesting corollary questions to ask in this space. What about regulation? I just think it's interesting to look at some of the regulatory issues and look at how they're evolving, how things are changing, where there's imperatives for change and at greater pace. What are some of the key issues, do you think, to think about when we look at the sort of regulatory role in this space?
Yeah, clearly regulation was and is to some extent the trigger of some of the trends that we have been discussing. I think that you need to differentiate a couple of things. First of all, jurisdiction. US regulation and European regulation are different. I'm not going to say that they are materially dissimilar, but they are different. Europe is much more banking market than the US. And I think that when you double click in US, what you're going to see is also, to some extent, a different approach. And that goes hand in hand with what Joe was mentioning about mid-size or regional banks, right? Clearly, there is a lot of focus on the regulation, banks that are critically important for the system, big banks. Those have been under the scope of the regulation for quite some time, more than a decade. Reality is that the first half of 23, what it showed us was that some of the regional banks that in many cases are more supervised at a local level, at a state level, they have not been doing a great job in terms of risk management, either because they didn't hedge interest rate risk or because they executed loans that were not appropriate for the type of risks that a mid-sized bank should be taking. So I think that the regulator, particularly in the US, is now focusing much more on those mid-sized banks, is paying more attention to regional banks as well. And I think that the result of that is that there is a retrenching from those banks in terms of lending ability and capacity. I agree with Joe. I mean, we are seeing much more deal flow on the lower end of the market in terms of private credit. I think that there are great opportunities in not only corporate and specialty finance, but also in real estate as well. So I don't think that the regulation is going to get any friendlier anytime soon. So I think that this is a great time to be looking at private credit.
If we look to the future, then what are some other important questions, trenchant questions that people should be asking, themes, topics people should be engaging with? I'll kind of throw it over to both of you. Maybe Rodrigo, first of all. What does all this mean for retail investors, for example? Maybe address that, or maybe another point we should be looking to. What should dominate thinking, as we look ahead?
I think that, first of all, availability to retail investors has been around for quite some time. I mean, if you think about BDCs have been in the quote-unquote private credit space for years and years, and that is a product that has been available to retail. I think that the trend that you are seeing now is that large institutional managers already tackle the institutional channel, and now they're seeing an opportunity to go and keep raising money on the retail side of the equation. They do that through partnerships with large institutions, and that is the key channel for distribution. But I don't think that you're going to see any changes there. I think that that is something that is gonna keep moving. I think that, again, from a yield point of view, from a cash point of view, private credit offers an interesting product. In terms of questions that we need to be asking is, generally speaking, the credit cycle has been very benign. And I think that what is important is that what you do from an underwriting point of view, from the quality of paper that you are putting in place, is important to keep in mind that at some point the credit cycle is going to change, and you need to make sure that the portfolio, the positions offer protection to the investors through the structure, through covenants, and all the things that the lenders should put in place to protect the downside.
And Joe, just bouncing over to you then, what about a final takeaway as we look to the future?
Yeah, I think private credit is a very attractive tool that should be part of any modern asset allocation. And I think that people should not think of it as a short-term trend, but a long-term tool that they can utilize. Yes, you're giving up liquidity, but you gain a lot for it. You're getting a very attractive yield versus illiquid markets. But as Rodrigo points out, it has been a very benign cycle, a very long benign cycle. And at some point, the credit market, that'll change and things will turn. That doesn't mean it's a bad place to be. It actually, that's when you want to be investing in credit. When things get shaky is where, real strong investors find the best opportunities. And that's what I would tell people is don't be afraid of the market. It should be part of your portfolio. And you just got to make sure you're with the right group.
That was Joe Sciortino, and before that, Rodrigo Trelles and John Popp, bringing us to the end of this edition of the Bulletin with UBS, setting the agenda in the fast-moving world of finance each week here on Monocle Radio. Listen again and explore more at monocle.com. That's where you can join the club by subscribing to the magazine. Don't forget to discover more and find out how UBS can help you at ubs.com. And there's more from the team you heard from today at ubs.com/asset management. This is the Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.